Hi, and welcome back to Mike on Money. I'm Michael LeBlanc, Senior Portfolio Manager with LLC Private Wealth at CG Wealth Management. And today on Monthly Market Mistakes, we're going to be talking about thematic bubbles and the stock selection that goes into it. So let's start with what is a thematic bubble? If you've never heard the term thematic investing, it simply refers to a specific sector, industry, or a theme that investors are excited about. We've seen it in the past, like the dot-com rally in the late 90s or the cannabis boom of the late 2010s. And even today, there's a lot of talk around the AI boom. So have you ever wondered why certain investments or themes like the AI, EVs, cannabis, or even blockchain seem to take off overnight, attract massive investor attention, and then crash just as fast? Well, today we're going to unpack exactly how thematic stock bubbles form, what drives it and keeps it alive, and ultimately what causes it to burst. And most importantly, what you as an investor can do to try and recognize the signs before it's too late. As a thematic bubble happens, when investors collectively fall in love with a story, a theme, it's usually a theme about the future. It might be artificial intelligence like we're seeing right now, or green energy, biotech, lithium, outer space exploration, or blockchain. The idea is always compelling, and it's usually a technology that will change the world. And sometimes it's even true. The problem isn't that the theme is wrong, it's that investors start valuing the story instead of the businesses. When valuations move what's reasonable to what's possible, the market starts to detach from that fundamental analysis of the companies themselves. That's the seed of every bubble, a great story loosely connected to financial reality. So every bubble begins with a kernel of truth, a genuine breakthrough or innovation, a period of easy money and low interest rates, a few big early winners that capture people's attention. Take the late 90s tech boom, for example. The internet was revolutionary. Or the 2020s EV and clean tech surge. Government policy and innovation were tailwinds for those sectors, driving up prices. But then something subtle happens. The narrative becomes self-reinforcing. People see prices rising. They feel that FOMO, that fear of missing out, and then they buy it not because they understand the business or that it fits in their risk portfolio or their outlook, but just because it's going up. And the market shifts from investing based or fundamentals to buying instead on expectations of that momentum continuing and the higher prices just getting higher. Now, bubbles need fuel. The modern markets have plenty of that. Ease of access to capital, raising capital these days is easier than ever. Low rates, which except for a brief time there, we've had them for a while, and abundant liquidity has made it easy for companies to raise money and investors to borrow. Media amplification, financial news, social media, of course, YouTube, online forums, all amplify that excitement. Everyone becomes an expert, and every dip now is a buying opportunity, not really looking at that value trap of when prices start going down. There's a saying, don't catch a falling knife. You might get hurt. Confirmation bias. Investors seek information that support their bullish views. They already have a view that things are going to turn around and keep going up or go higher and higher, and they ignore everything else. It's easy to find information out there or an opinion out there that's going to support your views. You have to be careful. You have to really listen to what what the naysayers are saying and why, where are the risk. Don't have to always follow the risk, but know what they are. When analysts question valuations, they're often get dismissed as just missing the bigger point. But sometimes, there's real risk behind this unlimited growth. There's also the passive and algorithms out there buying. We see money flows into things like ETFs, thematic-based funds, quant strategies that buy because the others are buying, not because there's a fundamental reason to be buying. And that feedback loop just keeps intensifying and driving up the prices further. By this point, the story feels unstoppable, right? Skepticism becomes expensive, like if you've missed out on it, and you want to be on that ride. You want to be on that wave. You may be near the top of a thematic bubble when several things start to happen simultaneously. Things like valuation is completely disconnected from earnings, right? Often justified with new metrics like revenue per eyeball or total addressable market. Retail participation explodes. Everyone's talking about it. The same handful of names are coming up over and over again. We've seen this before, and we see it again and again, where there's always that story of the elderly risk adverse investor hearing from maybe younger relatives or from friends that they should buy some of these higher risk names all of a sudden, and when they start talking about it, maybe it's gone too far. We start to see companies rush in to go public, take advantage of those higher valuations through IPOs or SPACs. We saw SPACs during the cannabis and blockchain runs, massively. Spin-offs, companies spinning off unprofitable parts of the business or profitable parts of the business to separate it, just trying to cash in while the market is euphoric. Use of leverage starts to increase by companies and investors to try to chase those returns, assuming that those prices will only go one way. And at this point, the market is just overvalued. It's more than that. It's overconfident, and that's the final stage before gravity starts to take hold. And bubbles don't just deflate slowly; they pop suddenly, and it's rarely because there's an underlying issue with the theme. It's usually just because expectations became impossible to meet, impossible to continue that same level of repeated growth. Those catalysts can be something as simple as a disappointing earnings report, shift in interest rates. Those borrowing costs are going to, drive or slow up raising more money. It could see something regulatory change or politically change, or even just an absence of good news, right? People are just constantly trying to feed the news machine, and if there's no really great news to drive that next big expectation, it's hard. And when investors realize that growth won't be infinite, that margin matters, that debt matters, that profitability still counts. Valuations collapse. And suddenly the investors who said this time it's different rush for the exit. And that's when liquidity vanishes from these names. And just like that, the market reprices from hope back to reality. So what makes thematic bubble so painful is that they usually start from a truth, right? The internet did change the way things, happen. Um, Clean energy, could and very well will be the future. AI is transformative, but not all at once. The internet took time, and those valuations took time to grow. The stock prices themselves had to wait for that transformation to play out. And the good names, they got priced in over the next decade with growth, you know, multiple times over. But that growth doesn't happen in 6 months. It happens over a much longer period. And even great companies will suffer when we see a bubble burst. Investors who bought a story late will find themselves holding good long-term winners, but a short-term bubble price, meaning they're going to suffer for a very long time while they wait for that to rebuild. And as confidence evaporates, even fundamentally solid stocks can drop. We've seen it as much as 80%. Um, and you don't want to be left to hold in the bag when that music stops. So the key lessons isn't to avoid innovation, it's to separate innovation from investing. At LLC Private Wealth, our approach has always been risk first. That means before we chase an opportunity, we really assess the risk. Before we buy a theme, we evaluate the balance sheets, the cash flow, the durability of the business model. You can participate in new ideas without being consumed by hype, right? We always say sometimes, when gold is on the run, don't chase the gold. It's a commodity. The price is going to be volatile. Chase the company that's selling the pickaxes, because the companies servicing that industry tend to have higher cash flows, better balance sheets, still really good growth. But look for areas to participate without speculation or as much speculation. So next time you see a hot new theme, or you're looking at the current one, AI, lighten up on your social media, ask yourself three questions. First of all, is the company profitable? Or is there at least a clear path to profitability? Is growth funded by customers or capital markets? And are you buying a business or just the story of the business? Because stories are exciting, but only businesses, real durable cash flowing businesses, create long-term wealth. So as we've discussed in previous videos, don't overexpose yourself to any product or theme. Really understand your upside potential and that downside risk. And as always, if you have any questions about these or any other portfolio questions, feel free to reach out to us by email, phone, go to our website, mikeonmoney.com. Sign up for our monthly newsletter, our monthly news email, where we have these videos, our market updates, also our small cap specialist group are given their regular updates. So until next month, I'm Michael LeBlanc. This is Mike on Money, and thank you for watching.